Welcome back, everyone, to the weekly market analysis for the week ending March 31st. We're at the end of quarter one of 2023, the end of March 2023, and what a quarter it has been. Here we are looking at the S&P 500. We'll take a look through the various markets and kind of get our bearings about where we're at. And the question I'm asking today is this the new bull market? Are we into the new bull market, or is this just FOMO? And I think that's a legitimate question to ask, and I think there's a lot of different ways you could analyze this and look at this. We'll jump into that in just a moment, but I want to remind you to hit the like button and subscribe. And you can also follow me on Twitter at Mr. J. Thomason. And you could look at my free weekly Substack. It's at befinanciallyfree.substack.com. And the links for both of those are in the description below. And so, like I said, there's a lot to look at, and there's definitely the markets have been trending since the banking crisis, been trending to the upside. The S&P ever since the Friday close is up 6%. The NASDAQ is the big mover in the equity indices. From the March 10th close, we are up over 11%. And for the quarter, if you go to the beginning of the quarter, well, if you start from the end of December and you go until now, we have gone up 20% in Q3. It's one of the best quarters for the NASDAQ, definitely the best since only since last year. Actually, I think we had from the end of June, the last trading day of June, until the end of August. Let's see, we had this actually does beat that rise. So really good quarter, and there's a lot of momentum that direction. We'll talk about that in a minute. Taking a look at the Russell is the laggard, although the Russell was the outperformer today. And we'll take a look at the dollar. The dollar has kind of come off the last couple of weeks and then has been kind of just chopping sideways. The 10-year, big down day today, but has kind of been chopping sideways ever since the end of the banking crisis. Gold today down 0.5%. Chopping sideways in what's looking more and more like some kind of pennant. We're on the daily, so it doesn't look super nice, but some kind of pennant formation. That's what it looks like right now. Consolidating just below the $2,000 level. Here we are closing at $19.69, and about 31 cents. So gold has been pretty bullish. Gold has had a really pretty solid quarter as well. Let's see here. If we go from the end of December till now, gold is up almost 8%, which is a pretty big deal for gold. And obviously gold has been rising basically since September, October, November. So no matter where you start, gold is up over 20% since then. So that is still looking pretty bullish, although I have some thoughts about that. I'll share that with you shortly. Crude oil having a good bounce. I kind of feel like an idiot here. Crude oil is up 13% from its lows that just got put in. I feel dumb. I'll just share this here. I feel kind of dumb because I actually got the bottom right here. I took a trade right at about 65. It was about 65.70ish, and I was just riding that trade up. And then we actually got rejected at the support, or at the resistance that had used to be support, and we started to come off. And there looked to me to be some real concerns about what was happening in the economy and what the markets were going to price in. And so I actually got rid of the position, and so I feel kind of dumb because crude oil has, and honestly, the reason I got rid of the position, it's a learning experience. I definitely made a move too quickly, and didn't wait for my process to play out, because what should have happened, as you can see, and this is just a little bit into my process here, as far as the technicals are concerned. You can see here that the colorful lines, I call this when I post on Twitter or in my newsletter, I call it the tide line. And when the tide line is below this faded gray line, then that's a bearish tide, what I call a bearish tide. And what you notice is that when bearish tide is occurring, price has a tendency to come up and test one or both of these lines. And it's interesting to note that if you look at some of these crosses, like if you look at this cross back in November, it's when price appears to be the most bullish in this situation, where that's actually the opportunity to take the trade to the downside, because the downtrend is pretty intact. Price has been coming down since June of last year, and the momentum is pretty strong to the downside. So even though this is the type of situation where people would say, oh, it's a higher, we're making higher lows and price is bullish, and there were a lot of people, and myself included, that were pretty bullish on oil, but following the process, this is actually the smartest place to take a short trade. And so having said all of that, on a counter trend trade, so what you see here, you can see there's a little green triangle pointing up, and that is an exhaustion signal. And so usually when you get that kind of a signal, that's a pretty good opportunity to take a trade. And so if you took that kind of a bounce, then that was over 12% of a gain. And you notice that price came up and it tagged that tide line. And so what you notice as you just look at the prices that are on the screen, or as you see the candles that are on the screen, is price at least usually either touched or closed within the range or closed above the range, and those were all great opportunities to take short trades, and so, or higher probability short trades. And so my process, I only look to take counter trend trades if I get that exhaustion signal. And so what I should have done is I should have waited for this trade to play out, and I had already moved my stop to break even, but just let myself get a little too spooked here. And so even if I had left the trade at break even, the stop loss at break even, I would not have been stopped out even on this wick down. And it would be a pretty good trade. And like I said, that's up 13% just from the closing low. So mistake there, but definitely something to learn from. Definitely human psychology is tough, and you have to be willing to admit to your screw-ups and just improve from that and make yourself get better. So a couple things I want to look at that I wanted to mention. Oh, sorry, we'll take a look at Bitcoin really quick. Bitcoin has been just on a tear and just going sideways. I have been highlighting these exhaustion signals. It works a little bit different on Bitcoin because Bitcoin is, like crypto, is a different kind of asset. But usually when you string a couple of those indicators together on the upside, that's usually a pretty good sign. And look, if you look up here from March of 2022, that sign was a good reversal signal. And unfortunately now, what's interesting now for Bitcoin is that the tide line crossed, made a bullish cross. One of the things that I had noted in videos, I think it was in a video, it was definitely in my newsletter, was that we ended up breaking down in price and before we got this cross. And so typically, the rules typically suggest that when price is up above the faded line, if the tide line is below, then that's usually a good opportunity to short. But of course with crypto it's different, so I just kind of was watching, and I actually have long thought that the bottom was in. So I've actually taken trades here and missed this one, but definitely had a trade already from here. And and so you got this oversold exhaustion signal, and that was the right opportunity, which again, because of what was going on with price and because of the situation, there was nothing really certain about it. And so definitely didn't get the signal right there. But now this has crossed, and so the smart thing to do on a bullish cross to the upside, there are basically two things that you could do. You could either buy on the cross, or you wait for the first pullback to the tide line. So it would be somewhere around there. So that would be a level to watch on Bitcoin. So again, some learning experiences there, and you honestly you have to stick to. You have to have a system, and you have to stick to it. And when you deviate, that's when bad things happen. And so that's the lesson there. I wanted to talk about the DXY for a minute. So speaking of those rules with the tide line, what's interesting to note is that I've been posting on my newsletter that this is the type of area where you would actually want to take shorts, take positions against the dollar. But of course, the whole macro situation is so messed up, and the positioning against the dollar right now is so heavy that honestly, like, this could, all it would take is, some kind of news event, some kind of surprise to force this thing to kind of rocket back to the upside. And I don't know that it would make a new high. I'm not willing to go out on a limb there, but it's entirely possible. So that's a tough one. And the dollar hasn't made new lows yet. For the year, so that'll be something to watch. Definitely want to be watching. Probably not these two candles, but you can see the support right about there, going back here to January. So that would be the appropriate level to watch. I mean, you can see that was also a decent level back in May and June of 22. So definitely want to call that out. And then I wanted to look at the Russell. So the question I asked at the beginning was, is this the new bull market? Are we in the new bull market, or is this FOMO? There's a couple things that I like to look at, which are suggestive of that this actually may just be a FOMO rally. And so a couple of things we had in the PCE report this week, which came in a little bit around and slightly below expectation as far as the inflation reports. Services, PCE services ex shelter was far below what it was, what they thought it would be. And the spending, some of the metrics regarding spending were up a bit. But all in all, it wasn't something that was super awful. I don't personally think it was bullish, but it wasn't super awful. And so I think that the markets felt okay about that. And then we had also inflation expectations, which interestingly, the 1-year inflation expectations were down, but the 5-year expectations for inflation were up. So that's very interesting that the market thought that was bullish. And generally, what you've been seeing, actually, let me go here. Let's see, XLK. Largely, this rally has been led by technology. Technology since the start of the year. Again, if we go to our trusty charts here, technology to start the year is up over 20% to almost 22.5%. That has been the primary leader here. In the NASDAQ, and it's been primarily driving the NASDAQ, also the S&P 500. What's interesting to note is that the S&P has not made a new swing high, and the Russell has definitely not made a new swing high, and the Dow has not made a swing high ever since its wick in December. So the NASDAQ is definitely diverging. If you actually look at QQQ against IWM, which is the NASDAQ ETF versus the Russell ETF, I mean, it's pretty insane, honestly. So you can see that price action. So there's been just a ginormous move back into tech, primarily. You can see that through Meta, which has had a pretty strong start. Basically, since its lows in November, it's up over 100%, and it's nearing 100% just for 2023, Q1 2023. There's also Tesla, which has been kind of started the year on the rocket and then is now getting ready to test its yearly highs, or its highs for 2023. So Tesla has been doing pretty strongly. So all of that is to say that tech is leading. But what's interesting is this Russell. The Russell has been lagging, and I think that that's a problem. You can actually see that the Russell has crossed bearish. It has had a bearish tide cross, and I do want to call that out. We did get quite a bit of testing of support. Kind of what's going on? Kind of in this area. So you can tell that that's pretty strong support. You can just follow all the way even back to late December for support there. This range has been important also going back into May and June, July, and it served as a little bit of resistance areas in October. So it's a pretty substantial area, and I think even going back, we were like this. See, this makes total sense. You look and you can see that these were our pre-COVID tops. It was also right around the top in September 2018 before the markets tanked in the Christmas massacre of 2018. So you should expect that this level is pretty strong. But it's just interesting that the Russell is continuing to lag because you can use the Russell for examples of risk on and risk off behavior. Just to take a look at a few things really quick, we have sorry, that's the wrong one. Let me find it. Oh yeah. So if you cross the Russell with the SPY, you can see there's been dramatic underperformance of the Russell compared to the SPY, and that's partially again because the Russell, the SPY includes it's basically 20% of the index is weighted towards those FANG stocks, and so you actually can kind of see just a dramatic move this direction. Another thing that you can look at is the small caps to large caps, and again that is it's basically the same chart. Another thing I like to look at is high beta to low beta, because if you see if the NASDAQ chart looks like this and it's healthy, then not only should the Russell look better, but also the where did it go? The high beta to low beta ratio should look a lot better. It should look substantially better. And yet what's interesting is that the high beta, low beta is actually lagging. And to me, that's not a good sign because, again, the Russell includes a lot of small caps, which tend to be high beta. And when in a true risk-on scenario, you would see those high beta stocks moving like outperforming a lot more than those low volatility stocks. So it's interesting to see the markets having this movement the last couple of weeks, and yet high beta to low beta is not supporting bullish risk on price action. So I do want to call that out. Another thing I want to look at here is I have a couple risk proxies. I write about these in my newsletter. JNK/SHY. So this is the junk bond versus the 1 to 3 year bond ETF, and it's a cross, but the tide works the same way on this. And I just want to note that this crossed negative back originally back in November of 2021, and we've basically been, as far as risk on, risk off, and high beta assets have been on the downside ever since. And this is the type of situation where here we are, we had a bounce up and we've crossed up above the tide line into what I refer to as the value zone on a bearish scenario, and this could go back up, but this could crash back down. And if this goes back down, then that would just, in my opinion, continue the conditions that are supportive of risk off, not risk on. So I do want to call that out as well. And then let me see, what else did I want to do? I want to take a look at the VIX. Let me get rid of some of these things so that it looks normal. The VIX had some spikes, obviously, after the banking issues back in earlier March. It has basically since been squashed down. Of course, this has been an area over the last year and couple months that usually where the VIX gets a bid. And we're actually not too far away from those lows throughout 2021, where there was basically no volatility and assets were just going up, 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 up. So I do want to call that out. We are setting up in a situation where things could potentially, we could get some more volatility in markets. And then the other thing I wanted to look at is credit spreads. Credit spreads are coming off a little bit, but they have been a little bit elevated. And what's interesting about this is actually if you overlay the VIX on this chart, sorry, I gotta fix this up. When you overlay the VIX on the chart, it doesn't make any sense if you actually look. The VIX and the credit spreads tend to spike together, and the VIX spiked along with the credit spreads, but then the VIX has come off while credit spreads are coming off, but have not come off quite to the same degree. So I think that's something to pay attention to. And then the other thing I wanted to look at is the Euro-dollar December contract. So when the banking crisis started happening and when the decisions were made to backstop the banks, you saw this. These are basically the Euro-dollar expectations for the Fed funds rate. They came crashing down to below 3 and even wicked down to below 3.5, implying cuts. And now we're back to around 4.41. And so we're about basically one rate cut down is what we're expecting. And so what'll be interesting is to watch this going forward to see if what happens with market expectations. Because if the banking crisis is contained, then I suspect that that the focus will be back again on the inflation fight and on jobs and things like that. And so we've got a big jobs report coming up at the end of next week. Obviously, we've got some holidays coming up, and so we're going to have some data releases that are happening in a little bit different. Well, actually, I think April 7th. I think that's the day. April 7th will, I think, be the non-farm payrolls release. But in any case, that'll be something to watch for because that's going to be the next big macro signal for what is to come, and I think the markets will take their cue from that. So I think that's all I wanted to talk about today. So just be aware, be aware that while things look pretty bullish, there was one more thing. I wanted to look at XLK on a different chart. So I have this chart, which you can kind of see on the bottom, on the right side screen, you can see a strength indicator. XLK is extremely overbought on multiple different fronts. It's overbought on both daily and weekly oscillators. It's overbought on RSI. It's on a daily RSI. It's getting close to overbought on weekly RSI, and it's pretty unsustainable, honestly. And actually, we have a bearish divergence on the MACD. You can see the MACD histogram is showing us a bearish divergence. You can see we made a higher high, but the MACD is making a lower high, and that's something I want to call out. The stronger signal would actually be on the weekly, and so if you look at the XLK, let's see if I can get the number on here. On the weekly MACD, 212, and then today we're at 183, and so we're making a higher high in price, but the MACD is not making a higher high, and that's something I want to call out because those divergence signals can be pretty strong to the downside. And so if you haven't taken any positions yet long equities, then you definitely don't want to chase this because it sounds cliche to say, but you really want to wait for a pullback, a decent pullback. The best thing that you could do is get yourself a 13-week moving average and wait for price to go back down and touch the 13-week moving average if you're on the S&P or on the NASDAQ and looking to take a position to the long side because that's going to be the greatest risk to reward because right now it's too risky. You could get a severe pullback. Even if it is bullish, you could get a severe pullback and be in a bad situation. So I do want to call that out as well. So take caution. My bias is that this is a bounce, that this is a FOMO bounce, and that it's unrealistic and not sustainable. But of course, we'll see. You have to consider all risks and position yourself for any possible risk. and then protect your downside. If that downside is shorts, and that means you're protecting against price appreciating. If you're protecting downside on longs, that means you're protecting from price depreciating. So you just want to make sure that you're managing your risk and protecting yourself for any of the possibilities. So that's going to be all for today. Thank you for tuning in. Don't forget to hit the like button and subscribe, and I will see you guys next time.